In this presentation, we will record the transaction for the purchase of equipment that we have financed. In other words, we have purchased equipment, we have not paid cash for it, but taken out a loan for that equipment. We're going to enter that transactions into QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. To think through our objective, we first want to look at the report. So I'm going to go down to the reports on the left side. We're going to open up that favorite report of ours, the balance sheet report. Within the balance sheet, we'll change the dates up top from 01/01/19 to 12/31/19. That's January through December 2019, and run that report. Our goal now is to buy fixed assets or furniture and fixture, large items. We're making a large purchase, and the difference between the large purchase is going to be that when we pay for it, or even if we don't pay for it, when we finance it, when we make the purchase, whether we pay cash or finance it, take out a loan or debt for it, we're not going to expense it at the point in time we pay for it. And that's not because we financed it. We're not putting it on the balance sheet as a balance sheet item simply because we didn't pay cash for it yet. We're putting it on as a balance sheet as an asset as opposed to an expense because it's something that's going to benefit us in the future for multiple time periods into the future. So that's going to be the goal. We're purchasing something. One side of the transaction will be up here rather than an expense in the fixed assets account, something that's tangible, something that we're going to be holding on to, some type of equipment or furniture and fixture that we're going to be using for multiple time periods in the future. The other objective we have is the fact that we are not paying cash for it. So we can't just write a check. We can't enter this into the check register and have the check register go down. What are we doing instead? We're financing it. So in essence, we're taking out a loan. So that's going to be a liability account. The other side needs to be in some form of liability account. So if we scroll down to the liabilities, we want something like a loan payable. So the loan payable account is the other side of the transaction that we're going to have. We're going to have an increase to the loan payable, an increase to the equipment or furniture and fixture type of account. So how are we going to enter that then? If there's no cash affected, no cash involved, we can't use our normal forms. In other words, we can't go up top. Most of these forms are not going to be effective because the transaction to finance equipment doesn't happen all that often. And therefore, there's not typically a form that we just think of that's automatic because these forms are given and used for those transactions that happen all the time on a daily or weekly or at least monthly basis, the routine type of transactions. If a transaction is not routine, then the default is usually a journal entry. So that, of course, is one thing we can do. We can enter a journal entry. So if we select the journal entry, we can say that we're going to enter debits and credits. And if we were to do that, then we would just increase the equipment account, the fixed asset account with a debit, and then we would increase the liability with a credit. But to do that, you need to know some debits and credits. To work around that, we could try to use the journals as much as possible instead of using debits and credits and try to work with a plus and minus journal format. We can't use the cash journal, but we could use some other balance sheet account. To see that, we can close this back out and we can go to the journals. We can go to the accounting and we can go to the chart of accounts up top. And we're looking for a balance sheet account. And we're going to say, well, I know that, for example, the fixed asset account has to go up and the loan account has to go up. So let's look for that fixed asset account. It's going to be typically in order by type. So assets, these are current assets. Here's the fixed asset account. Here's the cost. That's the one we want. This account's going to go up. We're buying more of this furniture and fixture type of account, type of asset. The large assets, we're buying a depreciable asset. So if we go into this register then, it'll look like a lot like the check register, but this register means that it's for the furniture and fixture account, and it will go up as we enter data related to furniture and fixture. We're then going to add a new item here with this drop down, and we're going to say it's not going to be a transfer, it's going to be a journal entry. So note, once again, QuickBooks doesn't have any other form that really will help to drive this transaction. It's just going to be a journal entry, but we'll enter it as if it's a plus and minus register type format so we can avoid knowing what QuickBooks is doing with the debits and credits. So we'll just select the journal entry. We're going to say this is as a 02/28/19, and we'll keep the number. The payee is going to be Office Depot, so we're going to say Office Depot. And again, it looks a lot like the check register, but remember, it's not the check register. We might want to put a memo. I'm not going to, however, any kind of memo to help us to know what the purchase is. And then we're going to say 5,000 is going to increase. That's what we're purchasing from Office Depot for furniture and fixtures, some type of fixed asset, some type of large item, tangible item we're going to be using for multiple times in the future, like a printer or something, a large printer or something like that. So we're going to say the other side is going to be to loan payable. We already have a loan payable account. Note that if you have multiple loans, you could say that you would like to have multiple different loan payable accounts and track those loans in their own account. That might be useful. Or, as we would typically do when we create financial statements for others, you may put all the loans into one account and then have the detail of those loan accounts in some other area, tracking it kind of like a subsidiary type ledger, a subsidiary account, possibly having amortization schedules that would show you the detail of those loans, the payments necessary for those loans. So that's just a kind of a preference that you would have. If you want more detail on the loans, if you have a lot of loans and you want to manage them more closely within the QuickBooks system, you would create another loan account and typically call it loan payable. Maybe just put the loan number, the last 4 digits of the loan number after it, and then you can track that loan balance individually. Or again, you can group them together. If you group them together, it's better for presentation purposes. In other words, if I'm going to print the balance sheet for somebody else, give it to somebody, they don't really care about how many loans we have or what the loan number is. They don't really want that on the balance sheet. They just want to know how much we owe in total on the loan. So just a couple things to keep in mind on the loans. So we're going to go ahead and save that. So we'll make sure to save it, or else if we leave the screen without saving it, then it won't be there when we look for it. Let's now look at the effect on the financial statements by going to the reports on the left side. We're going to go back to that balance sheet. We're going to run that thing once again. We probably should have saved it last time, but we're going to go up top and say 01/01/19 to 12/31/19, January through December 2019, and run that report. And if we scroll up top, we're going to say the checking account is not affected. We didn't pay cash. What we bought was the furniture and fixture. So the original cost of the furniture and fixture now at $148. If we select that item, we'll see the detail for it. And we see this, we put it in there at $50,000. Notice I tried to put it in there at $5,000 and it's in there at $50,000. So now I'm going to take that opportunity to go in there and adjust that from this point. So we're going to go in there and I'm going to select that item. Notice it's a journal entry that we have. And then here's the journal entry. It doesn't take us back to the register because although we entered it into the register like with other things, it usually will default to the form that's most appropriate. There is no form that's most appropriate because this isn't a transaction that happens all the time. Therefore, it went to the journal entry. When we see it, we have to deal with the debits and credits in this format. So here we have it. I'm going to change this now to 5,000. And notice QuickBooks is very forgiving. Why? It's very forgiving to let us make these type of changes, to go back in and make these type of changes. So there we have that. Notice also that if you have the journal entry and we paid part of the cash up front, then we'd have a journal entry with 3 accounts. We'd have to put the cash that we paid, which would be a credit, and that would lower the loan amount. So I'm going to go ahead and save and close that. Let's say drop down, save and close, drop up, save and close. So there we have it. Now it's been changed to 5,000. We're now at 103,000. So there's the one side. If we go back up top, I'm going to go back to our balance sheet. The other side then is going to be the payable account, the loan account. So here's the loan payable. We have it currently under the long-term loan payable. And this is going to be another kind of issue we'll have to think about. How do we break out short-term and long-term? Do you want to break out short-term and long-term? Is it worth your time to break it out? Why would anybody need to break it out? How can we manage short-term and long-term? What are the pros and cons for it? We'll discuss that in the adjusting entry process. It's easiest to track the loans in either one loan account or multiple loan accounts per loan. When we start to break out between short-term and long-term, because we might have some loans that are both have a short-term and long-term portion, we'll talk more about that later, they get a little bit confusing. So we'll talk about that later. Right now we have this one loan payable account. If we select that item, we have a new loan. There's the 5,000 we're going to have to make payments on in the future and track that loan balance. And then we had our other loan, which we said these two were basically combined together at $72,000, where we have our amortization schedule, where we had been tracking the payments, only the principal portion. We made the two payments for the 2 months, the beginning of this month and a month later at the end of this month. So now we're tracking two loans in this loan payable account. That's okay, but we just need to be able to support that with the amortization schedules. We should be able to come up to this basically loan balance number by adding up the current loan balances of our current loans that are due, and then of course to do that, apply out the proper portion of principal and interest, principal in this case, to the loan balance when we make the payments. For more accounting information and accounting courses, visit our website at accountinginstruction.info.